The word asset is used multiple of times when discussing wealth and business. Terminology can differ depending on what lens you choose to look through. From a finance perspective, an asset is something that has current or future economic value. For example, if you bought a property and put it on rent, that property is now an asset, paying you a monthly income. And chances are that the value of the property will also increase over time. Other examples of assets include patents, machinery, and investments. Cash is also known as an asset, but having physical cash will pay you no return. The cash itself has an economic value and therefore is worth something, becoming an asset. If you had cash in the bank will pay you a small interest percentage, paying you a return. If you use that same cash and invested in the stock market, chances are you will gain a bigger return on your money. So there are different types of assets, and they are usually ranked by how liquid they are, meaning how quick can you pull that cash out and use it if and when you need to. On the flip side, a liability is something which takes money from you, where you owe a person or a company money. A common example is buying a car on lease, where you have an obligation to pay for that car on a monthly basis. It's also common that the value of the car will also go down over time, and therefore reducing the principal of what you had put in. Other examples include your mobile phone, certain jewelry, and clothes, which are all products that take money away from you in different ways. It depends what lens you use to view your product to really determine its benefits. Having a regular gym membership may be a financial liability, taking money out of your bank, but it is also providing you the tools and equipment to strengthen your physical and mental health, which is actually priceless. Owning a car is usually a liability and its value goes down over time. But there are a handful of cars where their value actually goes up due to their rarity and scarcity. In some cases where you own a car, its value is going down. You could argue that you use your car to travel to and from work, which actually pays you probably 5 or 6 times the value of your actual car, making your car an investment to ensure you can get paid in your job, which is becoming an asset. Which is actually an asset. Over the course of your life, you ideally would want to be buying more assets than liabilities. In fact, there are certain wealthy individuals who completely live off their assets and have no need to work again. An example being a gentleman who managed to purchase £1 million worth of shares over the course of his life. Not only had the value of his shares increased over time, but he was getting a dividend payment from these companies, roughly equating to 10% a year, giving him a nice income of £100,000. Better yet, he managed to purchase these shares through tax-efficient saving accounts, meaning that his income is completely tax-free. Please be wary that not all property, stocks and shares are increasing valued assets. There are risks with all products, and you should be careful in terms of what investments you choose to make. Please subscribe and like the video if you had enjoyed it and found it useful. Please leave a comment on what other videos you'd like me to cover.